5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Tensions escalating. Iran and the US exchange fire overnight after Tehran shot down an American helicopter. CPI on deck, investors bracing for the latest print with strong jobs data, bolstering bets on Fed rate hikes. And an all-star lineup throughout the day from SuperReturn as private market dealmakers flock to Berlin. Don't miss our interviews with Churchill Asset Management CEO Kencel and Brookfield Private Equity CEO Anuj Ranjan this hour. All right, let's get a check on how markets have been faring around the world. A volatile week so far. Let's get straight to Winnie Su in Hong Kong for the latest from Asia. Winnie.
Good morning, Vonnie. We are seeing investors turning more cautious in Asia ahead of that CPI data from the U.S., especially after these hot prints from the U.S. jobs number last week, reinforcing the bets for the Federal Reserve to raise rates. And hence, you can see that MSCI Asia here down 2%. And also, the declines are mainly led by South Korea's Kospi index down 4.5%. Now, the bright spot is still in the Indonesia market, with the index here up 2.7%, still extending gains from yesterday as the Bank of Indonesia raised rates yesterday. Now, flip aboard, we take a look at the inflation numbers from China because we continue to see that divergence with the CPI and PPI numbers. When it comes to the PPI, we are actually seeing a bit of an uptick there, while CPI continues to struggle, coming at 1.2% year over year, and that is missing estimate of 1.3%. Now, it really goes to show how these manufacturers continue to struggle to pass these higher input costs to their consumers, and that consumption demand remains pretty weak, and hence we are seeing the onshore yuan, in fact, erasing some of its earlier gains.
All right, Winnie, thank you so much. Now we'll get over to London for a look at Europe. Here's Justina Lee. Justina.
Good morning, Vonnie. Now, here in Europe, we always have the fear of missing out on the AI trade, but actually this month is kind of helping Europe hold up a little bit better, even after the sell-off overnight. And of course, U.S. futures still down. I mean, the stocks Europe 600 down modestly, and we can see, of course, there's still kind of a big fall when it comes to tech stocks, but ultimately for the European benchmark, that's a relatively small weighting, and I think that explains kind of the relative resilience in European stocks here. Also pretty resilient are Italian stocks, as we've been talking about. ST Microelectronics actually kind of is doing pretty well today, and also a lot of focus on those Italian bank stocks, potentially over a deal that's kind of the talk of the town in Milan. And now if we flip the board here, now a lot of focus is, of course, on the US CPI number today and also the ECB decision coming tomorrow. Now we can see here that when it comes to short and bond yield, that's been on the rise kind of all year long, reflecting the gains in oil. Now when it comes to the move tomorrow, everyone's basically expecting a 25 basis point hike from the ECB, but the focus is on whether they're going to telegraph kind of more hikes coming this year, with traders unsure of whether we're going to get 2 or 3 by the end of this year, Vonnie.
All right, Justina Lee, thank you so much. Justina Lee there in London. Resilience in Europe, as Justina said, not so much here in the United States, though we should reserve judgment until after the CPI data. That could change the calculus wildly. Yesterday, we had, again, a wild day. At one point, the S&P was down 2%. At one point, it was up 1%. So these markets are really confounded. Right now, we are pointed lower. Lots of geopolitical tension in the air, even though oil is not reflecting that so much. Lots of offsetting factors for oil, of course, including emergency reserves getting released and inventories getting drawn down and all sorts of other things supporting prices potentially to have them not rise as much as they potentially would. But we do have the VIX trading at a 21 handle. Yesterday, it was really just the tech companies and energy that sold off. Everything else in the market was strong. We'll see what happens today, but right now, futures pointed lower and bond yields are staying where they were. So just a little bit of a movement, maybe a basis point or two here and there, but we're back up, as you can see, 413 and change on the 2-year and almost 501 on the 30-year. All right, let's get to some individual movers now. Back over to London and Chloe Melly. Chloe.
Good morning, Bonnie. We're seeing a real retreat in that tech sector this morning as traders expect U.S. inflation to hit the highest level in more than 3 years. And at the same time, we have also got those renewed tensions in the Middle East and all of those worries about this potential AI bubble. And so all of this is dragging down that sector this morning. Moving on, but staying within tech, and Supermicro is also seeing a bit of weakness after announcing a plan to raise $7 billion through equity offerings to buy the components that are needed for AI servers. And so this announcement is dragging down there. And finally, we've got Cracker Barrel boosting its guidance thanks to very strong sales of its patriotic merchandise. And so that is really boosting the stock this morning, up almost 10% for Cracker Barrel.
All right, Chloe, thank you so much. Chloe Melee there in London. Also coming up this hour, we'll be live in Berlin at SuperReturn with Churchill Asset Management CEO Kencel and Brookfield Private Equity CEO Anuj Ranjan. Plus, we'll count you down to the CPI data with Andrew Hollenhorst of Citi later this hour. Overnight, Washington and Tehran exchanging attacks after President Trump blamed Iran and retaliated for the shooting down of an American military helicopter off the coast of Oman. U.S. Central Command describing the operation as a proportional response. Iran later hit several U.S. targets across the region, according to state-run media. Bloomberg's Abir Abu Omar joins us now from Dubai. Abir, where does this leave what already has been a fragile ceasefire?
Indeed, Vani, a fragile ceasefire. But look, for the time being, we saw the attack from the U.S. side and the retaliation from the Iranian side. That is across countries in the GCC, including the U.S. Fifth Fleet in Bahrain, a U.S. base in Kuwait, and then another U.S. base in Jordan as well. From both sides, however, it seems like the hostilities have ended. For the time being, President Trump is adamant on the fact that the deal or negotiations towards a truce are still underway. Our own sources report to us that the truce talks are going intensely and that Pakistan is still very much involved to get this MOU through the line. And look, from the response that we got from the Central Command, from the United States, it looks like this retaliation or that this response in the U.S. attack was very much calibrated. It looks like it was proportional. This is quoted from CENTCOM saying that the attack was proportional to the degree of attacks that came from Iran earlier on. And so it looks like it's ended for the time being, but President Trump has come across over the past 2 months or so and said that reaching a deal or an MOU or an interim deal that would reopen the Strait of Hormuz immediately and extend the ongoing ceasefire for 60 days, he said that that was imminent multiple times before. The last of those was yesterday, where he said we could see a deal within a day or two. So we continue to monitor the situation and whether President Trump will come again and say anything about this MOU getting through the line. But for the time being, as I mentioned, the hostilities seem to have paused in the Middle East for today, at least.
All right, Abir, thank you so much. That's Abir Abu Omar there in Dubai. Here in the U.S., results for congressional primaries rolling in, with Democrat Graham Plattner winning his Senate race in Maine and GOP incumbent Lindsey Graham securing his spot in South Carolina. Kate Ackley of Bloomberg Government joins us now from Washington. So, Kate, what can we tell about turnout in Maine that gives any kind of clues as to what the runoff and what the November portion of this is going to look like?
Well, for sure, Graham Plattner, the Democrat there who won handily, he's had a lot of negative media stories, stuff about his past and his relationships with women. He still was able to get more than 70% of the vote there, almost 75%. But, the state's governor, Janet Mills, who had suspended her campaign, she still picked up a fair number of votes. But you look at that general election matchup with sitting senator, the incumbent Susan Collins, and we're just expecting to see a ton of attention on this race. Really a key battleground race for control of the Senate. It's one of those situations where obviously President Donald Trump is not on the ballot in these midterm elections. So races like this will be sort of a proxy. We're going to hear a lot about Trump, and already, Graham Plattner in his speech last night was talking about Susan Collins being, voting too much with Trump, even though she does have a fairly more independent voting streak than many other Republicans. But that's going to be a big line of attack. Expect to hear a lot about Trump, who obviously is not on the ballot there. And yes, you mentioned Lindsey Graham won his primary in South Carolina, easily. So we've seen some other general election matchups set going out to the battleground state of Nevada, for example, where a President Trump-backed candidate won the Republican nomination to take on Congresswoman Susie Lee in the 3rd District. So, we're starting to really, as we get through this primary season, starting to see these general election matchups really take shape throughout the country.
Kate, thank you so much. We will be looking forward to the primaries coming up with you as well. That's Kate Ackley joining us from Washington. Let's turn to tech now, and TSMC reporting a 30% rise in monthly sales as companies rush to build AI infrastructure. Joining us now is Neil Campling. So Neil, 30%, certainly the market is not suggesting that it was a better than expected number. ADRs are down in the pre-market. At the same time, it was better than last month. What can we tell about the earnings season, let's say?
Yeah, morning, Bonnie. I think you mentioned at the top of the hour about the volatility in the market tape yesterday, and underneath the hood, actually, if we look at the chip sector in particular, there was an 11% intraday swing from highs to lows at some point during the session. So investors are nervous about the sector, given it's had a massive run, and TSMC have just delivered an improvement from the April numbers. But given that the street analysts are expecting 35% growth for all of Q2, we're going to need to see another incremental uplift in terms of that growth rate in the June monthly sales to meet analyst expectations. So good numbers, but we have a high bar to beat for the rest of the quarter for sure.
Can we talk about ASML for a second? Because its gains, while great year to date, haven't matched those of its peers. Does it have the same pricing power, and can it ramp up supply?
That's a great question. I think, interestingly, perhaps it's a reflection of the fact that Europe has few tech winners, again, as you alluded to earlier in the program. But if we look at it, ASML has probably got the greatest pricing power of all the chip equipment makers, because it really makes the leading edge technology manufacturing productions that no one else can make. It really has a monopoly in the business. So perhaps it's a sign of being European more than anything else, but actually it should have more pricing power than I think many investors give it credit for, to be honest.
All right, Neil, we have to leave it there, but much appreciated. Neil Campling of Bloomberg News. Now to other top stories trending on the terminal this morning. Apollo co-president Scott Kleinman sees private equity capitulating on valuations after borrowing costs are normalized. Speaking with Bloomberg's Dani Berger from SuperReturn in Berlin, he said PE has lost its way a bit and some managers will now have to raise smaller funds or, quote, go away because of mistiming investments. SoftBank's talks to raise at least $6 billion through a margin loan backed by its OpenAI stake have stalled. This coming just weeks after SoftBank cut its initial target from $10 billion. According to sources, the company is considering various fundraising options and could move forward with the margin loan at a later stage. SoftBank declined to comment. And Florida-based Vanguard Energy is in advanced talks to send Cuba its largest U.S. fuel cargo since the Eisenhower administration. Vanguard is set to ship 100,000 barrels of gasoline and 150,000 barrels of diesel. That's enough gasoline to supply about 11 days of typical demand. The fuel is designated exclusively for the private sector rather than state actors. Coming up, Churchill Asset Management CEO Ken Kencel joins us from SuperReturn in Berlin. This is Bloomberg. This is Bloomberg Brief. I'm Dani Quinn in New York. The biggest names in private markets gathering in Berlin for the SuperReturn conference. Bloomberg's Dani Berger is live at the event for an exclusive conversation. Dani.
Bonnie, thank you so much. I'm so pleased to say that here at SuperReturn, I am with Ken Kencel. He is, of course, the Churchill Asset Management CEO. Ken, wonderful to see you.
Great to see you, Dani.
Look, you've been a busy man at this conference. I know you chaired the Private Debt Day.
Yes.
I just wonder, what's been the mood? How does this SuperReturn and the private credit players, how does it compare to years past when, we were kind of singing Golden Age from the rooftops?
Right. Golden Age from the roof.
Yeah.
Well, maybe it's more like platinum design or platinum period, maybe versus golden age. But I would say the mood is optimistic. And optimistic because for the first time, you're seeing some disruption in the market that is actually creating opportunity, right? So obviously, concerns about redemptions, concerns about AI and software, but for traditional middle market lenders that maybe aren't as oriented to software or AI, and there are those of us that aren't, I would say more optimistic about terms and structure and opportunity to do new loans than lenders have been in some time.
Does that mean if you are still one of the lenders that, unlike Churchill, has been very over-indexed to software, that you're still feeling the pain right now, that they're not really making it through this period as unscathed?
I would say redemptions are causing certain lenders to pull back, but that's creating opportunities for other lenders. So we're, for example, we're very low software. We're less than 5%. So for us, the dynamics today actually are creating opportunity. Opportunity for new deals, opportunities to maybe do some larger deals that ordinarily would have gone to the BSL market or even to those large cap private credit managers. So in that sense, I'd say a better dynamic than we've seen in some time.
Can you explain that a bit? Why are larger deals coming your way now? What in the dynamics has changed that's allowed that to occur?
So the folks that were doing those kind of large cap deals, many of them were software, were primarily driven by retail flows. So if you look at what's happened to those firms, because of the redemption pressures and the redemption dynamics, they're pulling back a bit. And those were the firms that were generally leaning into those private credit deals at the upper end or even the BSL market. So with that bid gone, you're seeing traditional private credit managers like Churchill and others step in and get access to somewhat larger deals, but on terms that are more consistent with a private credit execution.
So part of the retail pullback that happened, it was in large part software, but it was also this bigger conversation of are marks honest? Are funds really marking these things how it should be? Is there some can kicking, extend and pretend? I wonder if that reckoning has happened in this industry. When you look out in your peer group, do you think marks are more honest today than they were in the past?
Look, I certainly think private credit marks, and all of us, pretty much all managers today are getting quarterly marks from third parties. I'd say private credit marks tend to be more direct and more influenced very quickly because of those third-party valuations. I mean, all of us that have publicly registered vehicles utilize third parties on every asset every quarter. So I think in that sense, it's translating very quickly into our marks. Private equity tends to be a little bit slower, longer term in terms of how they look at things. And many of them don't have public vehicles, so they're not using third-party marks. So I think in private credit, you're seeing that play out pretty quickly, and I would say pretty transparently.
Because of some of the stresses of other players, consolidation has been a really big theme. Churchill, I know you're celebrating your 20th anniversary
20th
this year.
anniversary, yes.
Happy.
We rang the bell.
Very
couple
cool.
Weeks ago.
I actually remember seeing you on. We had you on our show. We called you out. I know you didn't see us, but we saw you.
Correct.
20th anniversary, and you've been now with Nuveen for some time as well.
Yeah.
And I just wonder how we should be thinking about consolidation in this industry. You've done this, you've melded with a larger platform.
Yeah.
Just how difficult is it? And are you expecting that process to happen a lot? And should there be a lot of speed bumps we see as funds try to come together?
I think you are absolutely going to see continued consolidation. The difference today is that in order to be relevant and really be active in private credit, you have to deliver the whole solution. And that means $300, $500, $1 billion of financing. The days of clubbing up in advance of each lender doing $50 or $100 million are over, right?
Why is that? Why are club deals over?
Because the private equity firms, primarily the drivers of those new deals, are looking for a full solution. If they're looking to raise $500 million, they're not going to go to 5 people today. They're going to go to one lender.
That's interesting. So it's not just the LP side, it's also the buy side that's driving
the buy side, the private equity side. So the result is the largest scaled players are seeing the most attractive deals. And it's become very difficult to build a diversified portfolio if you're starting from scratch. So we've seen consolidation in the space, larger managers raising more capital. I think the statistic I saw was 95% of the capital that's been raised in private credit over the last 5 years has been with managers that have had 4 or more funds. So the allocators are looking to consolidate the number of firms they work with. That's resulting in a consolidation in the marketplace overall in terms of lenders at scale. And I think smaller lenders are going to try to find larger partners or be part of larger platforms as fundraising becomes more important.
Do you think we'll see a lot of heartbreak, if I can torture a metaphor? Marriage is hard, and it's hard to undo.
Yes.
Especially when egos are in the room, which
yes.
this industry might have 1 or 2.
Yeah, 1 or 2. Yeah. I think the benefits of a global platform from a fundraising perspective are actually very significant, right? So you're seeing smaller managers be acquired by insurance companies. You're seeing smaller managers see the benefits of being on a larger platform. You've seen traditional asset managers want to get into alternatives and acquire private credit, private equity, and other types. So I think the consolidation is something that's here to stay. And certainly we've benefited from our partnership with TIA and Nuveen and having global distribution. And I think that's going to be a theme for sure.
Does it go beyond smaller lenders looking for larger lenders? Do you think it will also be the case that if you're a standalone private credit, you need to have equity, you need to have real estate, that you also see more asset class leaders come together too?
Absolutely. Absolutely. I'd say if you're a boutique today, you're going one of 2 directions. You're either accepting that you're going to continue to be a boutique and have a very clear niche where you invest. You've seen that with some of the lower middle market managers, maybe some of the distressed or restructuring managers. But if you want to raise broader capital and scale your business, global distribution is absolutely critical. And there are only a few platforms that can help provide that, right? Whether it's a large-scale traditional asset manager or even an insurance company, I think that's going to become the name of the game. So I would say you're going to see a bifurcation of managers, either go large and scale or stay a boutique, stay very niche focused, and kind of be what you are, which tends to be more limited from an investor standpoint.
And obviously you have a huge global distribution channel as well, given, as you were saying, TIA and Nuveen. So are you fielding phone calls every day of someone saying, hey, Ken, can you buy us up?
Well, it's interesting. So we're launching new strategies all the time. So we're launching a capital solutions strategy. We're looking at credit secondaries, but it's all in and around our private equity relationships. So I think the best managers are evolutionary versus revolutionary in the way that they grow and build their platforms. So we are looking at adjacencies to grow our platform where we already have strength in relationships and we can capitalize on that. So absolutely have benefited from TIA's support and Nuveen as a global partner. Obviously, they're going through their own transaction now with the Schroders deal.
Right.
So I think, we look forward to continuing to build that global platform. And look, institutional investors continue to allocate to private credit. Despite the dynamics in retail with redemptions, if you look at institutional allocations, they remain growing and actually are up year over year in private credit. So despite all the noise we've seen in retail, having institutional global investor base is very important.
I only got about 30 seconds here, but I'd be remiss if I didn't ask you. The flows are coming in. There's still institutional demand. What is the big opportunity right now, Ken? Where are you putting that to work?
I would say that it's actually a very attractive opportunity. We're seeing larger deals. We're seeing wider spreads today, 50 to 75 basis points wider spreads today. And we're seeing a dynamic, because of the disruption we've seen in retail, where the dynamic overall today is actually favoring lenders versus borrowers. So a little disruption is not a bad thing.
Certainly not, Ken. We're going to have to leave it there. Thank you so much for joining.
Thank you.
Always a pleasure to see you. That's, of course, Ken Kencel of Churchill Asset Management.
Dani, thank you so much. That's Bloomberg's Dani Berger. Let's get straight now to your front page news. Major news outlets leading with the US and Iran exchanging strikes following the downing of a US helicopter gunship off the coast of Oman. U.S. Central Command says its jets struck Iranian air defense, ground control stations and surveillance radar sites near the Strait of Hormuz. The U.S. says the operation has been completed. Iran then said it had launched drone strikes against a U.S. Navy fleet in Bahrain. All right, coming up, we're going to look ahead to the CPI data with Andrew Hollenhorst of Citi. Stay with us. This is Bloomberg Brief. 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Fragile truce. Iran and the US exchanged fire overnight after Tehran shot down an American helicopter. CPI on deck. Investors bracing for the latest print with strong jobs data potentially bolstering bets on Fed rate hikes. And we're live from SuperReturn in Berlin as private market dealmakers flock to the city. Don't miss our interviews with Brookfield Private Equity CEO Anuj Ranjan and many more later this hour and into the next hour. So we have equity index futures on the decline. Yesterday was a strange day. The S&P at one point was down as much as 2%, up as much as 1%. This was a tech-led sell-off, tech and energy for the most part, with oil prices continuing to be muted, dampened even as there was escalation overnight between Iran and the United States. But as you can see, it looks like we might be in for another decline day for tech companies. But we wait till after the CPI print because that, of course, has the potential to change everything. Right now, we're trading with almost 21 handle on the VIX, so definitely tension rising. The dollar index is trading at 99.9. The yen trading at 160.43. So there's lots of potential little pain points in this market here. Volumes have returned as well. Total equity volume was the third highest of the year yesterday. If we look at bonds, we can see that we are still elevated, remaining so, back up a point for the 2-year yield at 413.49 and back up another more than a point at nearly 501 on the 30-year. Let's get to some individual movers now. Over to London and Chloe Melly. Chloe.
Good morning, Bonnie. It's set to be another tough day for the US tech sector, with traders paring back that exposure to some of those names because of that CPI data that we've got later on, but also those renewed tensions in the Middle East and some of those worries around a potential AI bubble. So we're seeing all of those names in the red this morning. Moving on, but staying within tech, and Supermicro is also seeing some weakness today after announcing a plan for a $7 billion equity raise to buy the components that are necessary to make those AI servers that are in very high demand from that company. But we are seeing that weigh on that stock a little bit. And finally, let's flip over to Cracker Barrel and end on a positive note, because that is a company that has boosted its guidance, and we are seeing that reflected in that stock this morning, up almost 9%, really seeing that strong demand from its patriotic products. So good day for Cracker Barrel at least.
Chloe, thank you so much. Chloe Melly there in London. Iran's foreign ministry saying it is reviewing its diplomatic process with the US. A state-run news agency reporting that the ministry's spokesperson added, quote, "Wherever necessary, our armed forces will respond to the enemy with authority." This all after Washington carried out what it called proportional strikes against Tehran following the downing of an American military helicopter near Oman. Bloomberg's Abir Abu Omar is back with us from Dubai. Abir, it looks like things have calmed down just a little bit. Is this potentially done for the moment?
For the moment, it seems like that would be the case, Vani. But look, we had a 24-hour calmness after Iran and Israel were exchanging fire earlier this week. And then we had this attack by the United States on Iran. This is after Iran yesterday downed a U.S. military helicopter. No one was injured. The 2 crew members were reported to be safe. But President Trump did tell ABC News yesterday that he must retaliate or respond to Iran in a very powerful manner. And this is what we saw happen with a lot of sites in Iran, including Qashm Island, seeing explosions. A couple of water tankers as well had seen explosions in parts of Tehran, and that led Iran to respond by retaliating against Gulf allies, or some Gulf allies, as well as Jordan this morning. That is what we saw. Some U.S. bases in Kuwait, as well as the U.S. Fifth Fleet in Bahrain and a U.S. base in Jordan. Now, President Trump throughout this whole thing has maintained that a truce is underway, that it is imminent, that we could see it in a day or two. This is what he told reporters in New York yesterday. And so we wait and see whether this deal is in fact imminent. It's not a narrative that we haven't heard over the past couple of months for sure, but this is what we're going with for the time being. And what else we're going with is the fact that the hostilities between those 2 warring parties for the time being, again, seem to be over for the day, Vani.
Abir, thank you so much. Abir Abu Omar there in Dubai. Citi's Andrew Hollenhorst looking ahead to the CPI print in just a couple of hours, writing, quote, May inflation data overall unlikely to change the recent market narrative that sticky price pressures may lead the next move in policy rates to be a hike rather than a cut. I'm pleased to say Andrew joins us at the desk. He's chief US economist at Citi. Of course, Citi and you not looking for a hike next. In fact, looking for 3 rate cuts still by the end of the year. Is that still what you're thinking?
That's still our view. We think cuts are certainly more likely than hikes. To get to rate hikes, I think you need to see evidence that inflation is really picking up, the labor market is tightening, and we have kind of broad inflationary pressure. But having said that, the Fed does have an issue here with their preferred measure of inflation, which is core PCE inflation. That's been elevated. Core CPI should come in a little bit cooler, a little softer today, but core PCE is still going to come in quite strong. We think there's some methodological reasons for that, but it's a big messaging problem for the Fed. How do you talk about holding rates steady, even cutting rates, when you have core PCE inflation that's running north of 3% now?
So is that what Kevin Warsh will do next week? He'll come in and talk about other measures of inflation, and if we get a hot print today, he'll be able to say we're not concentrating on the traditional CPI data?
Yeah, I think that's the key question for Warsh. If you look at core PCE inflation has been the Fed's preferred measure. When they talk about the 2% target, that is a PCE target. What we heard from Warsh in some of his congressional testimony and earlier was this openness to thinking about things like a trimmed mean inflation. So what you're trying to do with these various measures of underlying inflation is cut out the outliers. If you have prices that are rising very quickly, prices that are falling very quickly, things that are volatile. What you do with a traditional core measure, you strip out food and energy. What you do with a trimmed mean is you just say, let's take out those things that are outliers and let's just focus on what's kind of in the middle of the distribution. That trimmed mean PCE number is down at 2.4, 2.3%. So that looks a lot closer to target as opposed to core PCE itself, which is above 3%. So what's Warsh going to focus on?
And we also have the Cleveland Fed's median, right?
Yep.
But there are problems with both of those indicators too.
Yeah.
Andrew, what should we be watching out for if we do start to look at those instead?
Yeah, so this is going to be the big debate. Which measure should you look at? How should you look at those measures? I think what I would like to see Fed officials do, what I think they might ultimately come out with, is not emphasizing any one measure over another. Yes, PCE is the target, but we're trying to get a sense of underlying trends. So try to basically take an average of these measures and say, if I look across all these measures, where are we? I think if you look across all those measures, we're somewhere certainly north of 2% inflation. I think we could argue, is it more like 2.5% inflation? Is it 3% inflation? But the trend has been downward. That's the important point to me. Let's see what Warsh has to say about it.
Andrew, what would it take for you to change your mind on 3 rate cuts by the end of the year? And bear in mind, 2 of those rate cuts you say are coming before the November midterms.
Yeah, so we have inflation that's above target. We have an economy that's still expanding. So the only real reason for the Fed to be cutting rates here would be some concern about the labor market. Now, you look at the last 3 jobs prints, and we have an acceleration in payroll growth. So you say, okay, how could this Fed be even thinking about cutting rates? I think what we need to see is some weakness in the jobs data. Those payrolls numbers have been strong. If you look at the full constellation of labor market data, we still see pretty weak hiring, pretty weak demand. We saw that in that NFIB small business survey. Small businesses are not excited about hiring. So if we see weaker labor market data over the next several months, then we would still be on track for those rate cuts. On the other hand, if we have a strong jobs report for the month of June that we'll get in early July, that would be a signal to us that the Fed's not going to cut this year. We'd shift those cuts out. The bar to hikes, I think, is very high. So I don't think we'd be putting hikes into our forecast, but could we be pushing those cuts out further? Yes, if the labor market data stays strong.
And they would go sort of as a trio. Or you're saying that if you decide to change your mind, all of those 3 cuts will be shifted out of this year, not just one?
Yeah, I think we'd probably shift all of those 3 cuts into next year with the idea that by next year, we think that we're going to see inflation that really has come down to something closer to 2%. We still think that we're on that track. It's obviously been a very, very bumpy road to get there with this issue that we're having now with core PCE. But the idea that, yes, the Fed can slide rates back towards neutral.
You're not concerned about secondary impacts from the Iran war then? You think that's pretty much behind us in terms of what it will cause prices-wise?
It's still early days. It usually takes months for those effects from energy prices to pass through to core inflation. But 2 things are making us feel a little bit more confident that we're not going to have a big pass through into core inflation. One is that the oil price spike just wasn't as high as we were worried about, right? We were talking 3 months ago about, could we get oil prices up to $200 a barrel? Certainly we're elevated, but we haven't seen those kind of numbers sustained. And then number two is, how is this coming out and passing through into the areas where we would expect there to be very quick pass through? Things like airfares. We've seen airfares go up, but again, that effect has been relatively muted in the U.S. as well as internationally. So that's making us feel more confident that we're not going to get a lot of pass through into core inflation.
In terms of who else is on the Fed, many people say, look, it's going to be consensus. It's not just Kevin Warsh. Now, we know Kevin Warsh is going to have a very strong voice at this Fed, particularly in the beginning, because the Fed is going to want to show, support for the new Fed chair as well. Who will he have as allies, or is there anybody we should be watching out for in terms of potential dissenters or people that really will not be in agreement with him on economic views?
So that's absolutely right. He has to forge a consensus. He's going to want to forge a consensus. And we had some dissents at the last meeting. We had 3 Fed officials who said the Fed should now formally have a neutral bias, not to be easing, not to be hiking. Right now they have an easing bias. That probably will come out of the statement, and there probably will be consensus around that. And I think Warsh can characterize that as just providing less forward guidance. I'm really interested in where Governor Waller is going to be. We've seen Waller, who's been quite willing to look at the data, change his views. A few months ago, he was more worried about the labor market. Now he's less worried about the labor market and more worried about inflation. So in terms of somebody who could kind of swing and potentially be an ally for Warsh, potentially have a different view than Warsh, Waller would be someone to watch.
Andrew, we have to leave it there already, but cannot wait to speak to you after the FOMC decision next week. So this is the appetizer to the main event, if you like, with the CPI data later today. Andrew Hollenhorst of Citi joining us there. Now to other top stories trending on the terminal this morning. Democrat Graham Plattner won the party's Senate primary in Maine after a campaign riddled with accusations of past misbehavior. Those include a since covered up Nazi symbol tattoo and a report that some of his ex-girlfriends found his behavior disturbing. Plattner will now face incumbent Republican Susan Collins in a race that is increasingly important for Democrats if they want to reclaim control of the Senate. Apollo co-president Scott Kleinman sees private equity capitulating on valuations after borrowing costs are normalized. Speaking with Bloomberg's Dani from SuperReturn in Berlin, he said PE has lost its way a bit and some managers will now have to raise smaller funds or, quote, go away because of mistiming investments. The Qatar Investment Authority's deal-making push may be hampered by Iran's attacks on the country's energy infrastructure and its inability to ship products. The conflict is expected to cost Qatar about $20 billion in lost revenue and impact the sovereign wealth fund's financial resources, which are linked to gas revenues. Coming up, back to SuperReturn, an exclusive interview with Brookfield Private Equity CEO Anuj Ranjan next. This is Bloomberg. Some breaking news. We are getting information from Kyoto that the Bank of Japan chief Ueda is in hospital and will miss the policy meeting. He's going to be absent from the policy meeting this month, and he's expected to be in hospital for about 2 weeks. As we know, the yen has been trading around 160.45. It is still around that level, but this is important news for BOJ watchers. Obviously, a hike expected at this month's meeting, but the BOJ chief will be absent from that meeting. He's hospitalized and will be in hospital most likely for about 2 weeks, according to Kyoto. Let's head back now to Berlin, where leaders in private markets are gathered for the annual SuperReturn conference. Bloomberg's Dani Berger is at the event with another exclusive conversation. Dani.
Bonnie, thank you so much. I'm so pleased to say that I am here with Anuj Ranjan, the Brookfield Private Equity CEO. Anuj, thank you so much for joining.
Thank you for having me.
And just looking at the backdrop of where things stand for private equity right now, deal volume, realizations are down about like 20% so far this year compared with last year. It is this logjam that has been ever present. We're talking with Scott Kleinman earlier, who said we still have a while to go to work through that. Is that your estimation, too, that this kind of stickiness, the stuckness of the industry is going to take some time to get through?
I think yes, but I think it's really differentiated into different categories of the private equity universe. Resilience is really the new growth, and the markets used to pay up for things that could scale very fast. And today, it's changed. The market is now paying up for things that can't be knocked over. Businesses or assets that are hard to replicate, hard to replace, that are critical to the global economy and form the backbone of it. These are the areas that people want to invest. And if you own businesses in that space, there are still buyers in that universe. And it's not just about the public markets. It's not just about the sponsors. It's about strategic investors that want to own these businesses for the long term.
What I also hear from you is just asset heavy. I mean, what you're describing is an asset heavy business. How big of a paradigm shift is this for the private equity industry? Because it used to be high cash flow, asset light, really fat margins. Is that model now pushed to the side? Is that gone?
You know, it's not pushed to the side, but I'd say more broadly, even if you look beyond private equity, the world is shifting. And even the world's biggest and greatest technology companies are now asset heavy. If you think about it, AI, it needs power, it needs land, it needs chips and compute, and it needs steel. And these are some of the critical resources and ingredients to the success of AI and the success of these major technology companies. At Brookfield, we're a big investor in real assets. We find ourselves at the center of this build-out, and it's created a tremendous amount of opportunity in a space that actually one would have not normally considered was traditional private equity in the past.
And you've been in real assets for some time. That's certainly part of Brookfield's DNA. A lot of other people are trying to make this pivot now too, which maybe haven't before. Maybe they were more software inclined investors. And I wonder how much of a change is it to have an IC to evaluate these companies? Do you think it's difficult? I don't want to call them tourists, but people who are more new to heavy industry real asset, is it difficult for them to make the switch?
Absolutely. I think these businesses are amazing companies. They're highly resilient, they're highly durable. But knowing and understanding them at depth, knowing and understanding the operations of them at depth is not something that's so easy to learn overnight. It takes decades of building a capability. Not much different than building a capability in software or in technology or in consumer. And my personal view is the private equity universe is very big. Those that will do the best are the ones that focus on areas where they can run businesses better than anyone else could. It's probably not possible to run such a wide array of businesses so great. You have to have a spot where you have history and experience. Ours is heavy assets. It's a space that we've been in for decades, and it's a space that we know really well. We're leading in, and we're doing even more.
But for focus in that asset class specifically, it feels like money is going in to literally everything. Like ex-politician can lease some land in Louisiana and have some concept of a plan. An IPO and money comes in. It feels like money is flowing indiscriminately to anything that seems like it's linked to AI data centers. Does that end in tears?
You know, it's funny. Headline grabbing news is often around big IPOs of the tech companies that are coming, that are often AI linked, and that's where it seems like there's a bit of a gold rush. But while it grabs the headlines, there's actually, I think what the real point is that the public markets have actually been quite healthy and healthier than they've been in the past. And there have been many mid-market industrial businesses and other businesses that are also going public and also attracting those capital markets. But I think the real trick, to be honest, it comes back to owning businesses that create their own optionality for exit. Right. Coming back to your first point on DPI and the logjam, I mean, you want to own businesses that can be appealing to a strategic, that can generate cash flow and pay dividends, and that aren't only dependent on IPOs. You want to create your own exit, not be dependent on the timing of the public markets alone.
By the way, when it comes to public markets, do the big IPOs, do they help or do they hurt trying to exit via IPO? Because it is competing at the end of the day for the same institutional capital, and these are giant companies between SpaceX and the large language models that are likely coming public.
Yeah, look, so far we've seen that overall, I'd say it's helped. I'd say the inflows in public markets in general across IPOs or across issuances has been stronger in the last year than it's been in the past. And many companies have managed to go public that are hard asset linked, heavy asset linked, heavy asset services. At the exact moment that a big IPO comes, like this Friday, maybe there's an attention shift. But overall, I think the public markets are healthier than they were in the past.
So you wouldn't recommend taking a company public on Friday, for example?
Maybe not.
Might not be the move.
Might want to wait past the weekend.
Yeah, I think that's probably fair advice. By the way, on these large language models, you have this partnership with OpenAI along with some of your peers, the Deploy Co. I know it's only been a month. It's in its infancy. Just how is that going? Has the work started there yet?
Absolutely. Look, we're really, really excited about it. We think the AI race is shifting. It's shifting from invention to execution. And the technology is no longer the bottleneck. The bottleneck is being able to deploy AI at scale in industry, in enterprises. And the winners in this market will not be those who have the best model. The winners will be those who can get the technology in the hands of real traditional businesses in the real economy as fast as possible. That's the gap that we're investing in, and that's the gap we're trying to fill with the deployment company, with our partnership with OpenAI. And it's an incredible opportunity. I think that's going to be where what really defines OpenAI and others as category winners.
Well, on that, because whether your competitors are part of this deal or not, it has been this attempt to try to enable companies with AI to make sure that they don't get left behind. Is there alpha generation to that, or when everybody has these tools, it becomes just a need to have, and it's not necessarily, if everyone's improving their margins through AI, it basically nets out in the wash?
It's a great point, and I'd say it's actually both. On one hand, there is alpha generation. There are absolutely productivity gains in these businesses. We've seen examples in many of the traditional portfolio companies that we own, where we've been able to derive real EBITDA improvements, cash flow improvements in a business. We've been able to reduce costs. We're able to help predictive maintenance or increase throughput of a manufacturing facility using real AI tools. So it does lead to real benefits, and we're really excited about that. At the same time, I don't think it's that you invest in AI as a business and you have alpha generation, but if you don't, you stay flat. If you don't, you get left behind. And your business actually, it may decline. And so there really are going to be winners and losers coming out of this. And so it is a little bit table stakes. It is something that if a company wants to survive and thrive in this new era, they do have to make the investment. They do have to deploy AI in their enterprise. And so they have to do that just to keep up. But those that do it well, those that do it fast, those that can do it at scale, I think they'll have huge advantages in the future.
Anuj, we're gonna have to leave it there, but just quickly before we do, on this point, the stuff is expensive. The cost of compute is just going higher. How are you thinking about that in your portfolio companies and the margin compression or the margin pressure you might face as they adopt more AI and use up more tokens?
You're absolutely right. Compute is one big bottleneck. It's one area that we see all of these groups trying to expand. But the truth is, the productivity gains need to pay for that. And a lot of those productivity gains are not just the compute power of the technology, it's actually utilizing your people, upskilling your people to be able to use technology more efficiently and to deploy it more efficiently in your company. And then you can maybe minimize how much compute you need or that cost while maximizing the impact on the business.
So you're not token maxing, you're not calling your CEOs and being like, hey, how many tokens can you use at once?
Not yet. Maybe I'll see something different in a year.
Anuj, thank you so much for joining. Such a pleasure to see you here in Berlin. Vani, that's Anuj Ranjan of Brookfield.
Dani, thank you so much. Bloomberg's Dani Berger will be bringing you interviews throughout the day from SuperReturn in Berlin. Now a look at what's ahead for your trading day. First up, the main event today is May CPI. That's out at 8:30 a.m. New York time, obviously. Then we get the federal budget balance. That's at 2 p.m. Eastern. And earnings coming from Chewy before the bell and Oracle after the close. Here are some pre-market movers. Supermicro tumbling once again, down more than 8%. It says it's planning to raise $7 billion in an equity deal for AI equipment. TSMC, well, came in with sales rising about 30% in May. Investors not loving that. It's not on track to beat for the earnings quarter. We'll see what it does next month. Oracle down more than 3%. It's falling ahead of earnings due after the market close, and we're anticipating quite a large move after earnings, at least according to options markets. Let's take a look at your macro environment as we go into the Wednesday session with a lot of question marks. So we have NASDAQ 100 futures pointing to a second down day for the NASDAQ. Remember, yesterday we were going to be looking at a second up day, and it all turned around. Tech selling off and continuing to sell off in the pre-market. The 2-year yield is at 4.13. It is back up that basis point that it lost yesterday. And we have the VIX trading just below 21. It was above that just a few moments ago. This unsettling environment that we're in, where the US and Iran were trading fire overnight, appears to have stopped for now. But there is that tech sell-off to contend with as well. And volume is back. This is what we're looking at in terms of Brent crude. So even with all of those over and backs, Brent hasn't really advanced. We're at 91.26, and WTI is still below $88 a barrel. Gold as well continuing its sell-off. It's staring firmly in the face now of $4,000. All right, that's it. Do stay with us. We will be counting you down to that CPI data, the all-important data coming at 8:30 a.m. Eastern. It will be key in terms of the Fed decision coming next week. We also want to reiterate that we got news that the Bank of Japan Governor Ueda is hospitalized for 2 weeks and will be missing that Bank of Japan meeting next week, where widely the bank is anticipated to hike rates. That's it for Bloomberg Brief.